Ahoy there, trader, and welcome back. This is the Anti-Investor Swing Trading Podcast. So let's talk about the stupidity and recklessness of buying every dip just for the sake of buying the dip. So stop buying every dip. Not every dip is worth buying. If it were, well, do I really need to finish that statement? Now, trying to buy every dip is basically the problem that most traders, new and old for that matter, face when trying to trade the trend. And that statement is the first clue as to what needs to be done to ensure your success when swing trading. So let's explore the correct way to not just buy any dip or find any dip, but to actually find a dip worth buying. Because not following this process, a swing trader will continue to unsuccessfully buy any dip and chase the bear market move all the way down until their account blows up. Hi, it's Phil. Welcome to the Anti-Investor Swing Trading Podcast, where we talk about swing trading stocks, stock options, and index futures. My goal is to help the next 1,000 traders become financially independent and retire early from the financial markets by providing the right tools to use, the rules to follow, and the software to assist you so that you don't make the same mistakes that I made. And from now on, I'll be your personal swing trading mentor to show you the way. So if you're ready, let's do this. Well, fun and games today. So stop buying every dip or every down day or every down week and calling it a dip. There is no context for it, and this is the biggest mistake that a trader will face. It's sometimes referred to as being akin to catching a falling knife, meaning that there is a significant and real danger that you will grab the point of it and end up hurting yourself. Another trap to buying any and every dip is that it can turn a novice swing trader into an accidental investor as the stock continues to slip inside further into the reds, and you keep holding and holding and holding and hoping that it can just come back to break even. Now, this is often followed by the account killer called dollar cost averaging, which is to say that if you liked it at the high price, well, it must be even better at this lower price, and now it's moved significantly lower, and thus we better buy some more, which reduces the average buying price, and oh shit, it continues to slide further into the red, and whoops, there goes my account. Some of us don't learn from that lesson. Now, the good news is that there is a simple and much better way to go about buying the dip. This is how you find a dip worth buying, which in my backtesting and research validates on average and works on average between 49.2% and 63.4%. It depends on the stock and the time frame. There's a few variables, but it's got this average expectation that is what I like to fancily refer to as a positive expectancy strategy. It works on stocks, indexes, and other instruments that I like to trade on a regular basis. Now, you'll probably laugh at the absurdity of how simple this process is. And it's by no means 100% foolproof. Nothing is. Nothing works 100% of the time, so let's get over that straight away. But as long as it works on average enough, then it's going to be successful. Just like any other business for that matter. Now, it's better than what most swing traders currently choose. And again, it's worked on average for me enough times over the last 28 years to make a long-lasting career out of this. So the first step is to define the trend. Now, I don't mean guess the trend, which is what most people do. Look at, which in fairness, by guessing, you're just looking at the last 10, 15 bars and kind of hoping that you pick the direction right. So if you're doing this visually, ensure that you have at least 12 to 15 months loaded up on your daily charts. And if you're looking at any other time frame, about 250 to 300 bars elsewhere, and you'll be able to make sensible assessments. You'll be able to see visually if it starts at the bottom left and finishes at the top right, you've got a positive or bullish uptrend. Similarly, if it starts at the top left and finishes at the bottom right, you've got a downtrend. You can make a very clear, easy, simple, visual interpretation. Still a little bit of subjectivity involved, so let's go one step further. I like to have a very clinical, definitive mechanical assessment using a combination of moving averages. Now, this means that I can make it rule-defined with zero subjectivity. So for a bullish trend, the 50 period moving average needs to be above the 200 period moving average, and price needs to be above both of those moving averages for a trend to be called a trend. Simple. Now, I also like to use the 20 period moving average, but just for simplicity, we've got no visuals. I'm just going to describe the two moving averages, but we can layer on the third one as well. Now, after the trend has been defined, it's only then that a dip can be looked for. And you can only buy a dip in the context of an uptrend. And similarly, you can only sell a rally in the context of a downtrend. Look, another sidebar. You did know that you can profit from downward movements in the markets. Yeah, good. I also defined what I then consider to be worth a dip worth buying. So price needs to pull back towards and into the 50 period moving average and at least touch the 50 period moving average. So it's going to go from above all the moving averages to back to the slightly faster one, the 50 period moving average in this case, and this is what I'm going to call it a dip. It also means that I can ignore everything else. Ignore any down day or 2 days, 3 consecutive days. I can ignore a down week. If it's not at the 50 period moving average, it is not a dip. Notice how I'm phrasing it. It's a statement of fact. It has happened. It has touched the 50 period moving average. It has done this. I'm not guessing. There's no subjectivity. And that means that a dip worth buying then becomes when price pushes higher and resumes the trend that we've defined. Now, it sounds super simple because it is. It's also mechanical in nature, which means I can pop those rules that I've given to you on the back of an envelope and pop them into a computer and call it an algorithm, sprinkle in my preferred money management routine, and voila, we have a strategy. And at the click of a button, we can spit out a multi-decade performance of reports to validate the strategy and the equity curve and all the fancy gubbins that comes along with such reports. And basically I can validate, is this a strategy that consistently makes or has made a positive return over multiple occurrences, multiple decades, thousands of trades at by the power of a computer. And the idea being is that, okay, the trend, the consistency of the strategy performing, it's unlikely to change in the next 6 months. It's worked consistently for the last 20 years. What are the chances of it just suddenly not working in the next 6 months? Now, I can find the best stocks with this algorithm now, the strategy. I know the algorithm is just a fancy way of saying rules, if this, then that. That's all an algorithm is. Don't overcomplicate, don't overthink it. But what it means is I can find the best stocks, the best indexes, the best ETFs, gagging on the phrase, crypto if you want to. You can trade quite literally anything that you've got data for that you can plug into these rules and it will spit out a performance report. And I can find the best opportunities on the best timeframes, the best instruments that behave favorably for the way that I want to trade, which is basically low maintenance. I want to be able to do it with minimal time invested at the computer. I want to be able to do it 20 to 30 minutes a day, whether I'm day trading, short-term swing trading, or longer-term swing trading, which for me is capture the main move of the day, the main move of the week, or the main move of the month. They're the three things, they're my strategy objectives. So that I want to be able to check in, check for trades, and check out, and then go and do something else. That's what it allows me to do when I've got clinical, clear, rule-defined, validated strategy. And this and the variations of the strategies that I've just mentioned, they're pretty much what I've been doing for the last 28 years, profiting from daily, weekly, monthly swings and anything that behaves favorably for the way that I want to trade, so I can check in, check for trades, check out, go hiking, spend time with loved ones, and do the things that I get pleasure from. So, the bottom line is stop recklessly buying every dip and destroying your account. Start by defining the trend, then define what a dip worth buying looks like to you, and mechanize the decision-making process so that you will never guess at trading again. And if you need some help with this, I've got a lot of time for serious traders. I'm very happy to point you in the right direction and help you discover if what I do is right for you, and if it's not, I'll always point you off in the right direction for your unique situation. Let's start the conversation. Shoot me an email over to phil@antivesta.com, or just hit reply on any of the emails that you receive from me. Right then, trader, that's all for today. Thank you for giving me your time, your attention, and making me a part of your regular routine. Have a wonderful day, and I'll speak to you at the same time next time. Toodaloo, trader. Keep in mind that futures, options on futures, stocks and stock option trading involves a degree of risk that may not be suitable for all investors. Past performance is no guarantee of future performance. Anti-Investor provides educational information and does not provide financial advice.